like you said, we have seen a big shift in the way the markets have been moving, a lot more volatile than they have ever been. What sort of trading are you now adopting if we walk through a system? Like, are you still looking to trade, unleveraged stocks, or are you doing CFDs, like starting off with picking a market first, Forex? Where do you start? And then, perhaps we can talk through what methods you're trading at the moment.
Okay, you're looking at top down, you look at what the market's doing. So what sort of opportunities is the market offering at this point in time? One of the things the market has at the moment is a fairly high compatibility with certain types of pattern trade breakouts.
Yeah.
So you look for those, and that's an eyeball scan. And rather than sit down every day and go through all the stocks that are listed, what you're doing is you're looking at other sorts of stocks, and you'll see these patterns jump out. They go on a separate list. If you're looking at the market at the moment, at this point in time, the market has done a good run, it's now consolidating. There is a reasonable danger that we will do a retracement in time and price, similar to what happens in Shanghai in the last couple of weeks. That means that we're looking at maybe a 10-15% price retreat, pretty rapid. I think October's a good time to do that sort of thing, followed by a sideways consolidation and a continuation of the trend. So that sets our strategy. It says open positions, we've got to be prepared to cut and lock in profits. If they're new positions, we have to be prepared to cut quickly and take a small loss. That's number one. Number two, when the market drops, if we're getting a correction in price, in other words, it's going to fall very rapidly, what we're looking is for stocks to retreat back to solid underlying trends. What's a solid underlying trend? Okay, we define that with a multiple moving average. So it comes back to the lower edge of that. That tells us we're ready to sit there and watch for a price rebound to develop. Now, we look at Shanghai market, because Shanghai market in behaviour is leading what's happening in the world. It's moving much earlier, usually 3 to 4 months prior to the behaviours we see in the US and other associated markets and ourselves. So we can see that once we get this correction in price finished, the correction in time is created with a whole series of short-term rallies. That means we need to shift our focus to short-term rally trading. Now, whether we do that by looking at, say, let's say the banks, for argument's sake, we take ANZ, pulls back. Okay, how do we trade that rally? The most effective way to trade the rally is to shift into a leveraged derivative rather than to trade the underlying. We might get a 5% return out of ANZ if we trade ANZ, but we might be able to generate a 15 to 20% return if we trade it on a leverage basis. But it's not an investment, because the probability is that the market will have the price correction. We'll now look for a time correction, rally retreat. Gives us an opportunity to trade short on the downside if we wish. That's our particular skill set. Once we see a breakout above the top of that trading band, then that sends a signal for a recontinuation of the uptrends. That's when you position yourself to be able to take advantage of those longer term uptrends. So you were looking for defined trading band breakouts as the trigger signal to enter into longer term trades.
What you've just explained right there is one of the things that really has set you out among the pack as far as your expertise, because you've mapped out what the market's doing, you've got the different strategies, and we're talking multiple markets. A lot of people, especially when they're first starting out, are going to have trouble identifying that sort of insight that you just gave just then. How can we sort of break that down? Like, where should someone focus? Like, I think we were talking about, okay, well, what stage are we in at the moment with the current climate? Okay, we're looking for those breakouts. Are we saying, well, how about you start off with, stocks? You only look out for breakout patterns. Just get breakout patterns, and let's do this right for this time of the market. Is that?
Yeah, that's okay. The market has thousands of opportunities to lose money. Right? That's there every day. So what you need to focus on, particularly when you're starting, is a particular set of processes or opportunities which suit you exactly, that you know you've got a great deal of success with. And you sit down there and you trade paper trading. Now, a lot of people talk about paper, it's a waste of time, it's not real, it's all the rest of it. That's garbage. That's backtesting. And we're talking about backtesting before, which I didn't answer your question. And the answer is I don't backtest significantly. You tell me where we can pull out a bit of history that's the same behaviours or even similar behaviours to 2008. It's not there. It's not there. We can't go back to 1930. 30's different behaviours, different instruments, different levels of volatility. You go back to the collapse in after the tech crash, again, not there. So the market is unique in very significant extent. And when major changes take place, you can iron those changes out. And that's what a lot of backtesting does. So we'll start with from 1901 and we'll move it forward to 2009, 2007. And what that does, it makes 1930 look about that big. That makes the collapse in 1987 look about that big. it makes the collapse look about that big. So yeah, it looks very small on this longer term chart. So, hey, what we've just been through was also about that big.
Yeah.
Not quite true. I just lost a fortune and a half of my grandmother's inheritance money. It's pretty important to me at that point in time. Historically, it is a small blip, but in real time, it's a major blip. So when we backtest systems that reduce the impact and significance of major market events, 1930, 1987, 1960, and so on, then you don't have a system that really works.
Yeah.
It's not adjusted to what's actually happening now. So that's one of the key factors. So how do we backtest? What you look for is compatibility. In other words, you've got an approach, an idea, you go back and you look at 12 months of data. Now, if I acted on this signal over that 12 months, how many false signals would it give compared to the number of valid signals? And this is on individual stocks, not on the market as such, okay? Because when we look at an index, the key factor with an index is made up only of winners, not of losers. So it's always going to go up. It's a wonderful thing. You can only pick winners. Retrospectively, it's always going to go up, and just drop the losers. And people think, the market always goes up. I can't possibly lose. Talk to people who bought Citibank or GE or HIH in Australia. All of these, they've got lots and lots of problems. GE, for example, sorry, not GM, Citibank, for example, looks really, really good, because what it did is it fell down below the trigger level for the Dow. So the only way that they could continue to remain as a Dow component, they did what they call a 1 for 20 reverse split, what we call a capital reconstruction. So you own 20 shares, now you only got one. Artificially, the price increases and it remains as part of the Dow. It's a winning stock. Not quite true. So in terms of back testing, I'm looking for compatibility in the current markets over a 12-month time frame. Normally, let's say prior to 2008, we'd look for compatibility over 2 or 3 years, because although the market from 2005 through to 2008 looked like it was similar, looked like it was the same, there were subtle changes that were taking place. As we went through in 2007, you could see the market accelerating. You've got clear warnings in November 2007, December 2007, that we're moving into a major bear market, and we called that a number of international publications as well as Australian publications. And we said at the time, okay, you go to cash, you close out positions, you move to short-term trading because time is the risk factor in the market. So you've got to look at the changes that are taking place, and you do that by short-term back testing. Take the stock, take the method, apply it. In the past, has it given reliable signals? The answer is yes. Then there's a high probability it will continue to give those reliable signals into the future.